What's up guys, and welcome back. Third and final installment on my tax videos. Yay, we're almost there. So good, right? Are we excited that we almost know how to do tax? I bet we are, but we're all super stoked. So in this video, we're going to touch base on depreciation for your vehicle. Now, the depreciation for your vehicle may be one of the largest deductions that you can do. So it's important that you pay attention. But first, just a quick disclaimer. This is Arnold Schwarzenegger. He is not a financial advisor. This is me. Like Arnold Schwarzenegger, I am also not a financial advisor. We both do not provide financial advice. This content is for education and entertainment purposes only. I'm just a dude who makes videos. If you need financial advice, seek a licensed professional. Now, I'll just quickly touch base on what I am not going to cover in this video. Now, I am not going to cover determining the value of your motor vehicle. I'm not going to cover that. Okay, you can do your own research and figure out how much you paid for your own vehicle. I'm not going to cover GST registered vehicles. Talk to your accountant if your vehicle is registered for GST. And thirdly, I'm not going to cover a total loss situation or resale of how it determines your value and tax proportions from there. Talk to your accountant if your car's been written off, or if you've sold your vehicle or traded a vehicle in to get your current vehicle. Talk to your accountant. Across this video, we're going to cover two methods. We're going to cover the cents per kilometer method and the logbook method. What we are not going to cover is the actual cost method. If you want to use an actual cost method, discuss this with an accountant. Cents per kilometer and logbook method are the easiest ones to do, and you still get great bang for your buck if you do it correctly. For depreciation methods, we're going to cover two different methods. We're going to cover a prime cost depreciation method and also diminishing value depreciation method. Probably doesn't make any sense now, but you'll know this in the next couple of minutes. So let's break it down to steps. So there's factors at play here. These are things that you need to make decisions on based on your own personal circumstances. The outcome from this video is to make a decision of which depreciation method you're going to do. Is it cents per kilometer, logbook, or actual method? And secondly, if you have a vehicle that's applicable, are you going to do a prime cost depreciation or apply a diminishing value rate? So you got to pick from three different factors and then two different methods, if they apply to you, of course. So let's jump straight into it. Let's look at our depreciation methods. Okay, so the first method we're going to have a look at is cents per kilometer. Now, this is the easy method to do. Cents per kilometer is a flat rate where you can claim up to 5,000 kilometers for business use at 72 cents per kilometer. This means the maximum that you can claim across the year per vehicle is $3,600. If you drive 7,000 kilometers or 30,000 kilometers, you can still only claim up to 5,000 kilometers for business use. Now, this flat rate payment of 72 cents per kilometer, this includes everything for the running costs for your vehicle. This is including the registration, the fuel, servicing, insurance, and the depreciation of your car. This means you cannot claim these things as additional deductions. For the 5,000 business kilometers though, guys, when it comes to your logbooks for this, you don't actually need a logbook. You just need to prove how you worked out that value of the kilometers for business use. So this method can work out great for people with a low value vehicle where they aren't really depreciating much of the cost of the vehicle, or for people who don't drive too much. So keep this in mind, guys. The cents per kilometer, the most you can claim is $3,600, which means you need to determine, are my costs to operate my car more than that or not? If it's more than that value, that's where you may be looking at another method. The logbook method. The logbook method is where we record down all of the mileage we've done. We determine what's personal mileage, what is business mileage, and then we can determine our business percentage from there. Once we know what our business percentage is, we apply that across everything for operating our motor vehicle. We apply that across the depreciation of the motor vehicle, the registration costs, the fuel, the servicing, the insurance. So as an example, if your business use was 50%, then 50% of your registration costs would be tax deductible, 50% of your fuel would be, 50% of your servicing, 50% of the insurance, and 50% of the depreciation of your vehicle. If you add up all the costs for operating your vehicle, then apply the business use percentage across it. If it exceeds the $3,600 for cents per kilometer method, this may be the method that you choose to use instead. By getting a value higher than the cents per kilometer method, the logbook method will allow you to get your best tax deductions. Unlike the cents per kilometer method, you are not being paid a flat rate per kilometer or per unit of mileage that you operate the vehicle. You are declaring and claiming across what percentage use of business your cost came to. The third method is actual cost. This is where you find out exactly what the cost for each item that you used for business use was specifically and exactly. If you're doing this method, have a chat with your accountant to see if it applies best for you, or if you should be using a logbook or a cents per km method. Okay, now that we know our overall methods to apply for our depreciation, let's have a look at specifically the car and our two depreciation methods for the vehicle. The first one is the prime cost method. The prime cost method is where we get the value of the car and we split it out evenly across the effective life of the vehicle. So based on a commissioner ruling, an effective life for a car is 8 years or a motorcycle 7 years. So we would divide the cost of the vehicle across its effective life, and that's how much you can declare as a deduction each year. So if you bought a car for $40,000, its effective life is 8 years. So we would divide the $40,000 by 8, giving us $5,000 per year we can claim as a deduction for the car. That $5,000 per year is how much that car is depreciating at. The second method is the diminishing value method. So like the prime cost method, we are still depreciating the value of a car, but we're doing it at a different rate. While the prime cost method is evenly spaced out across the asset's effective life, the diminishing value method sees it a little bit differently. The diminishing values view is that an asset loses most of its cost in the first 2 years. As an asset gets towards its end of effective life, there's less and less of it to depreciate. So the mathematics for the diminishing value rate's a little bit more complex than the prime cost rate. I'll pop it up on screen. This is the formula to follow if you want to apply this for yourself or to test your assets to see which one's the best to apply. But let's have a look at an example. So on the same basis of a $40,000 vehicle that's brand new with an effective life of 8 years. In year 1 of the diminishing value method, we would claim $7,500 as a deduction. In year 2, $6,093.75. But by the time we hit year 3, we would be claiming less than what the prime cost method is. But we're still ahead on our deductions. So year 3 will be $4,951.17, and year 4, just over $4,022. And those values will continue to get smaller and smaller each year until the asset reaches its effective life. Confused? Fair enough. Let's break it down to something simple to look at. Let's look at some examples. This is Timmy. Timmy drives 25,000 kilometers this financial year in his brand new car he bought for $40,000 on the 1st of July from his local dealership for their special first day of financial year sale. Across the year, he determines his business use is 80%. Timmy also works out that he spent $7,500 in services, insurance, registration, and fuel. Timmy now needs to decide how he's going to claim his vehicle. For the cents per kilometer method for his distance, he has done 20,000 kilometers of business use, but he can only claim a maximum of 5,000. The total he can claim as a deduction for his car and running expenses is 3,600 on this method. On the logbook method, Timmy realizes he may be putting himself in a better position, but he needs to decide if he will use the prime cost method or the diminishing value method. On both the prime cost rate and diminishing value rate, the 7,500 running expenses are charged the same. So as he is at 80% business use, he will be claiming $6,000 in deductions for his running costs. Now for the vehicle, if Timmy used the prime cost method over an 8-year effective life, he would on top of his running costs be claiming a further $4,000 per year, considering his 80% business use. This brings his total deduction for this year with the logbook prime cost method to $10,000. Now if Timmy used the diminishing value method over an 8-year effective life, considering his 80% business use, his first year he would claim $6,000 for the vehicle and the $6,000 for running, to a total of a $12,000 deduction. But his second year would be $4,875 plus his running costs. His third year would be $3,960 plus his running costs, and his fourth year would be $3,218 plus his running costs. Based off his first year, Timmy needs to make the decision himself. Does he want to claim higher in his first year with the diminishing value method, but have less deduction to claim in later years? Or does Timmy want a steady deduction for each year using the prime cost method to help offset his payable tax? These are the decisions Timmy or yourself may need to make. If you need help with this decision, reach out to your accountant to discuss. Other quick notes. There are maximum limits for the vehicle costs you can depreciate. If your vehicle is valued higher than these values on the screen, this is the most you can claim the vehicle's cost at. So you can't claim a full cost for a Lamborghini if your vehicle is second hand. Discuss this with your accountant. Let them know what the cost of the vehicle was, when you purchased it, and what percent you use it for business. Your accountant can advise if the cost you paid for the vehicle is deductible or not. Cool, you still there? Hopefully it's all making sense. Awesome. Okay, so the main goal that we want when we're doing depreciations on a motor vehicle is to get the largest deduction that you can get. So you may need to calculate and run through a couple of these deductions just to see which one makes most sense in your financial circumstances. If you get stuck, run it past an accountant. Just say to them, hey cool, I've got this car, I've done this many kilometers, these are my costs for running the vehicle. What's the best way for me to do this? End of the day, you want to keep as much money in your pockets when you're doing your tax. You don't want to be paying more tax than you need to pay. That's the whole point of depreciations. After all, these are costs that you've spent to operate your business to make money to pay tax in the first place. Why pay more tax than you need to? I didn't make the rules, man. I just follow the rules. But that's all for today, guys. Make sure you smash the like and subscribe button. If you haven't watched the other videos on tax, make sure you check out how to do a logbook and also how to do deductions as well. I've got them on my channel, so make sure you check them out. Make sure you see all three in this tax trilogy. Continue to drive safe on the road, guys. Keep hustling, keep making money, and until next time, peace out. This is more